We try to do it as fast as possible. We take all that. It's not like we don't know what we're doing. We will often know we're going in that direction, we're putting on that position or whatever, and we can backtest.
You have to understand that there are hedge funds out there who spend millions of dollars on algorithm trading, high frequency trading. If technical analysis worked 100% of the time,
The truth is, liquidity sits in very, very obvious places. Because liquidity is simply where traders put their stop losses. So where do traders put their stop loss?
And pretty useless. They don't give you a repeatable and systematic process that you need to use in your trading. They draw all of these fancy liquidity schematics, but on their own, let's be honest, when millions of them get together in a highly emotional money game of fear, greed, and uncertainty, their combined behavior takes on a herd mentality. And we can spot this on our price charts.
In the Microsecond domain, the entity with the fastest connection to the exchange queue doesn't just predict the future, they write it. To locate institutional footprints, high-frequency algorithms do. Not wait for news wires, they analyze minute, order book changes and immediate volume shifts.
The software analyzes factors such as market volume and momentum and order flow, and then automatically executes the trades with preset profit targets and stop loss levels to teach traders how to be disciplined in their tradings.
Monitoring real-time order flow reveals institutional block executions law before they are finalized. Algorithmic snipers utilize the fragmented queues of retail order routers to obscure their own front-running protocols.
You need to understand this is a very common mistake, and it can be fixed with one strict rule. Liquidity is everything for me. It gives me my direction, it gives me my bias, my entries, A to Z basically.
He is mastered
Fragmented retail flow. Speed in the Microsecond domain acts as both an offensive weapon and a vital defense mechanism for modern market makers.
What's the mindset in those scenarios when it comes to risk management?
Risk management is so key. You can't just come in and start trying to print money with no risk management. You have to stay in the game. One of the biggest parts of the game is staying in the game.
In highly competitive execution, queues, even a fraction of a millisecond determines who captures the spread. When massive block trades seek shelter in dark pools, aggressive algorithms use synthetic liquidity queues to uncover hidden boundaries.
Why a lot of traders lose money? They try to anticipate what the market is doing before the market does it. People call this manipulation. They try to break out and they fail. This is the reason we will get here. We are getting ready for the squeeze. The squeeze will be present here. Look.
There you have.
Once these boundaries are exposed, institutional orders are completely vulnerable to micro squeezes, high-speed snipers, and disparate exchange feeds, mapping large buyer-sell imbalances before the orders are processed.
He is of the market sniper. He has amazing insights into trading, into markets, and a whole bunch of different angles at these various financial markets and instruments that have made him extremely successful and popular.
Recognizing these structural imbalances allows the routing engine to position its limit orders optimally. Standard execution venues are unable to shield larger trades from algorithms designed to detect order routing anomalies.
Like 7 different schools when I was younger. So I lived in like Essex, I lived in Romford, I lived in Stanmore, I lived in Harrow, Woolstone, Wood Green, and then I've just moved.
These are all in London, right?
Yeah, like all in London, like obviously by the Essex one. I'm just for family stuff, you know what I mean, moving around.
Jumps in latency, permit, automated systems to sweep pressing liquidity before the market can adjust. Colocated systems trade purely on predefined systematic logic to execute order sweeps and fractions of a microsecond.
Motion out of it. When we do systematic trading, it's systematic. We try to do it as fast as possible. We take all that. It's not like we don't know what we're doing. We will often know we're going in that direction, we're putting on that position or whatever, and we can backtest everything. We don't sit and make decisions on the fly or whatever, and I'll give you an example how fast it is as well. Algorithmic trading has moved massively, so it's
eliminating human intervention ensures that execution speeds remain limited only by physical hardware. Subtle momentum shifts within the order book act as early warning signals for impending institutional reversals.
We want to see the candlesticks getting smaller and smaller as they approach a key support or resistance level, because this shows us that price is losing momentum. So you want to see price losing momentum and slowing down as it approaches a key level. You can see price literally form a big fat candle followed by a smaller candlestick and then another smaller candlesticks, and you can just see like the candlesticks start getting smaller and smaller.
Decoding these microscopic patterns allows algorithms to capture highly predictable spreads. High-frequency algorithms actively target massive order blocks, clearing out resting limit orders ahead of the primary trade.
This is a very high risk to reward strategy breakdown that we're going to be doing today.
This speed differential. Elite market participants design sophisticated routing logic specifically to secure premium placement in exchange queues.
Have a relatively basic strategy. I think from a high level perspective, I always want to see price rebalance into 50% of the range and then continue with the trend, right? And I built a model around that. The main thing that I consistently talk about is the daily and the hourly and H4PO3. They really marry daily buyer. So I want to see price trade here, but actually I'm more of I want to see price trade from here to here.
By predicting where the institutional sweep will land, snipers place their orders at optimal pricing thresholds. The combined mechanics of market participants generate a massive flow of orders that leaves distinct structural signatures.
When millions of them get together in a highly emotional money game of fear, greed, and uncertainty, their combined behavior takes on a herd mentality. And we can spot this on our price charts and make money from it. How? Well, you've got millions of market participants putting millions of orders through the market for a million different reasons. All of this behavior and participation is what drives the order flow that is put through the market.
When millions of orders interact, they form highly legible patterns that predictive systems readily exploit. Scalping strategies rely on isolating the immediate momentum of the order book rather than analyzing historical price trends.
Our time frame to find out like what's the momentum of the market, to find out like the overall trend direction. Is the market going up, or is it going down, or is it going sideways? And guys, make sure that you are just focusing on what price is doing right now. You do not want to be looking at price all the way up here, because it's irrelevant. You know what I mean? Like, it's irrelevant. Like, because we are scalping, we are only going to be using a 5-minute time frame to look for our entry. There is absolutely no point of like going all the way.
Focusing purely on immediate institutional block orders are highly vulnerable when split across fragmented execution venues with varying latency profiles.
You have to understand that there are hedge funds out there who spend millions of dollars on algorithm trading, high frequency trading. If technical analysis worked 100% of the time, don't you think they could have spent millions and millions of dollars to make billions of money every single day just because a stock is giving an ascending triangle breakout? So it's not something that works 100% of the time. That is the reason why your risk management becomes important. That is the reason why we tell you earn 6 out of 10 times.
Relying entirely on simple breakout patterns fails to account for the systematic speed advantages of institutional algorithms. Swing execution models are built on capturing predictable shifts between order book peaks and troughs.
Between the peaks and troughs, but the definition is broadened over time to include most short-term trading. Despite focusing on the short-term swings, swing traders usually trade with the broader trend, which means taking the upswing during uptrends and downswings during downtrends. During a sideways trend, they can try to trade both the up and the down movements. There are 3 components to a swing trade that should be determined before placing a trade.
Anticipating these directional swings helps market makers extract consistent value from structural order imbalances. Aggressive execution protocols are most effective when applied during periods of highly concentrated one-directional volume.
With aggressive entry. So for aggressive entry, this is best used when the trend is strong for a trend continuation entry. And then when we are looking at the time frame, it's best used in 15 minutes time frame.
Selecting the correct execution window remains critical to outrunning institutional order routes. Succeeding in high-speed trading requires absolute discipline, flexibility, and a complete absence of behavioral bias.
What we hope or wish the outcome to be, and also by who we'd like to think that we are. At the end of the day, you always know if you've won or lost, and usually, in my experience, you can trace the genesis of that outcome to something with your own character, which I find interesting. The kinds of questions that trading poses are things like, do you crack under pressure? Do you let your ego interfere with your objectives? Do you get wedded to your beliefs and have an inability to be flexible and change your mind when the facts change?
When execution facts change, the process of refining high-frequency logic involves learning from extreme risk events and system failures.
That took you about 6 years before you're profitable. What were some kind of aha moments that really changed things for you and your trading?
Well, I mean, I had a lot of aha moments every time I blew myself up and had big problems in the market, which were many, in the beginning, because I had no idea what I was doing. I had no mentorship. I had very little money. It was a very challenging environment for me.
Surrounding the logic with strict parameters is the only way to survive highly volatile market regimes. Algorithms trace the volume-weighted average price to pinpoint where major buyers or sellers are most exposed.
It was trading below the VWAP.
Trading below this critical threshold signaling key. Structural areas where blocks are highly active. Discovering microsecond edge requires synthesizing disjointed data feeds from multiple exchanges into a unified view.
Created tutorials like this. There was a bunch of different videos throughout the whole entire internet, and I kind of had to piece them all together.
Piecing these fragmented, automated high-frequency bots continuously parse direct market access feeds to identify block orders the moment they are staged.
Now make sure you have chosen the correct centralized exchange as well that you'll be using further down the video. Now let's go over to the Pine editor. It should be over here. Now here you need to code out your entire strategy. This is the entire crux of your bot. It decides where the bot will place a buy order and where it will place a sell order. Now to keep things simple and showcase you the real possibility of such bots, I have made my own Pine script over here, and I'll explain what this
This latency-arbitrage allows machines to step ahead of larger execution blocks with zero structural friction. Massive blocked raids trigger severe order imbalances that high-frequency models predict through real-time options data.
Over the last 4 weeks, principally as we've gotten some updated inflation and economic numbers that shows inflation is not gone and the economy continues to roll around. So you can see, if you look at the box on the right-hand side, that on January 24th, there was actually almost a 17% chance from a market expectation standpoint that there wasn't going to be any rate increase at all in March's meeting, and 80% chance.
Exploiting these structural imbalances allows snipers to lock in risk-free pricing before the public announcement. During low volatility consolidation phases, algorithmic systems trap block orders into early execution commitments.
Today we're going to talk about 3 push patterns, 3 levels of rise and fall, how that coincides within each session, how that can be applied each day as it unfolds, Asia, London, and New York, and each week, Monday, Tuesday, Wednesday, Thursday, Friday. If you look at your daily charts, the same principles will apply on the daily charts. And again, typically these will end in a big move. Now these can either end a move or they can be a continuation pattern.
Once these orders are committed, snipers sweep thin queues to profit from the resulting imbalance. Sophisticated volatility band configurations allow execution engines to detect the exact microcell on a block trade enters.
The first setting we're going to use, we're actually going to keep it at SMA here. But one important change, or let me actually go over the setting first here. So the source is very interesting. The standard, you can see it says close right here. That means that the Bollinger Band make its calculations based on candle closes. One setting you can use here is the OHLC4.
Aligning these calculations with precise candle parameters optimizes for running precision. High-frequency platforms must configure their execution parameters precisely to ensure optimal queue positioning.
Our periodicity is set just the way that we want it. So we're going to go up here. We're going to click on settings. You'll notice the 9 length on the close. That's our source. We're going to go ahead and hit OK. As you can see, we're plotted as a chart overlay and ready to go. Now on MT5, very similar, but there is a couple extra steps. You're going to go up to insert first. You're going to go to indicators. You're going to go to trend, and you're going to go down to moving average. Click on moving average.
Securing the correct setup allows the sniper to outpace standard exchange routing engines easily. Spikes in transaction volume are indicated by the physical height of order book bars, highlighting institutional activity.
And the height of the bar represents the amount of volume. So when we have tall bars, like for example right here, that means that we have a lot of volume. And when we have small bars, like for example right here, that means that we have relatively low volume. To see the exact amount of volume, you can hover over a specific candle, which in this case is a specific day. You can for example see that during this day right here, Tesla had a volume of around 447 million, while
Analyzing these volume signals allows snipers to isolate exactly where institutional block trades are executing. Liquidity is highly concentrated around obvious structural price levels where average market participants place their stops.
The truth is, liquidity sits in very, very obvious places. Because liquidity is simply where traders put their stop losses. So where do traders put their stop losses? Well, in this example, we have a very obvious level of support, and all the stop losses are going to be below this level. Traders see this level being respected on multiple occasions and expect that level to be respected again.
High-frequency engines trigger these clustered stops to clear the book and secure clean fills. Popular trading models often ignore how colocated systems actively exploit order block disclosures.
But normally how we start is nice and simple with everyone. Just tell us a bit about your journey, getting into trading, how long you've been trading for, some of the key moments. And then
intercepting these structural disclosures remains a primary profit driver for latency arbitrage firms. High-frequency market makers observe price consolidation ahead of session opens to map potential order flows.
Gold, so we're going to use gold for today. That is popular and something I trade myself. Also going to go through real life example of exact same concept I've used in my trading with a trade I have taken this week, and look at that. Show you this working in action as I do trade this live on a day-to-day basis. So to start, we're either going to have two scenarios before the session. Okay, we're either going to have before London Open, we're going to have some form of consolidation, or we're going to have price doing some sort of pullback.
Sweeping these precious liquidity pools allows snipers to position early before blocked raids hit the public. Discretionary trading models are highly inefficient compared to systematic, rule-based microsecond execution logic.
And pretty useless. They don't give you a repeatable and systematic process that you need to use in your trading. They draw all of these fancy liquidity schematics, but on their own, let's be honest,
a repeatable execution process is the only way to extract consistent value from institutional anomalies. The final stage of order book execution is completely dominated by machines outrunning human speed by several orders of magnitude.
Traders, people who want to learn trading and they want to learn trading with automation, or people who are not consistent in trading and they want to use automation to take out emotions out of their trading. Right. So we have two sets of people who use our bot. One, beginners who are looking for a platform to learn trading. For example, they need a software, they need a training, they need a support. So we provide all three things. People who are already trader, have been trading from last few years, but not
latency arbitrage turns microcircuitable imbalances into highly repeatable, low-risk profits. In the final calculation, the market is not a chaotic storm, but a highly structured machine where the fastest algorithm always extracts the toll.